Hey guys, welcome back to my channel. Today we're going to be talking about how to invest for beginners. Please be sure to stick around till the end of this video because some of the more important things that go into this strategy are going to come toward the end. If you like hearing these tips and tricks, please be sure to smash the like button and please do subscribe and let me know in the comments below that you enjoyed this content. The first thing I want to discuss is you do not want to invest with money that you are going to need in the near future, whether for retirement, whether for a big purchase you're planning to put a mortgage down on a home, anything that you're going to need to pay rent, to pay for food, to pay your month-to-month bills, right? Within the next 2-year period, you don't want to touch that money. That money should not be put in investment vehicles that are subject to any, real amount of volatility or any real amount of risk. Obviously, you're going to need that money in the immediate future, so you need to just kind of be wise about it. To some degree, investing is to some degree a little bit of gambling, right? So you don't want to gamble with money that you're going to need in the immediate future. That being said, if you have money that you can put aside for the next, I'd say 3+ years, like that's the benchmark you should have in your mind, that you're wanting to park it somewhere, hoping to get a good return on it, and you can leave it there for at least 3 years, then that is the type of money that we are discussing here. The first thing to understand is timing the market is basically an impossible task, and you should throw that strategy out the window and just concede to the fact that you're never going to get the timing perfect, right? And so you need a strategy that can compensate for the fact that you're never going to get that timing right, okay? And that's okay. Nobody is ever going to get the timing right. It's important for you to understand that you need to be in the market to some degree in order to benefit from the market, right? If you're afraid that you're going to buy in and the market's going to go down, then you're never going to buy into the market and you're never going to reap the rewards of being in the market, right? Part of being in the market is that the market goes down, the market goes up. That's always going to be the case. There are going to be days when you're in the market where the market goes down, and there might be days when you're in the market where the market goes down a lot, and it's pretty scary thing to experience. But that is why we only deal with long-term investments, because you are planning to give yourself time for that investment to recover. Something that a lot of investors don't understand is that waiting to buy in could mean that you miss out on the highest earning days in the entire year, right? According to a JP Morgan Asset Management retirement guide, by missing the 10 most profitable days in the year, you cut your potential earnings for the year in half. It had a major impact on potential earnings just by missing the 10 most profitable days in the year. And what's more is that if you miss the 20 most profitable days in the year, your returns actually become negative. So it's really important for you to be in the market so that you don't miss those 20 or those top 10 most profitable days in the year. And what's key is that, and this is the key part of why you cannot rely on the fact that you're going to time the market correctly, because a different JP Morgan study showed that 6 out of the 10 best days occurred within 2 weeks of the 10 worst days out of the year. So if you're trying to perfectly time that is such a small window of time. You will basically have an impossible time trying to predict when that has bottomed out, and you will not be able to do it. You won't be able to do it. You're going to miss the top 10 days. You probably will miss the top 20 days. And then you're going to really be like shooting yourself in the foot as far as your investment strategy for the year. So the lesson from these studies is that you cannot try to time the market, and committing to an investment strategy in both good times and bad, and having faith in your investment strategy, understanding your investment strategy and why in the long run it's going to be favorable to you, and just internalizing that and understanding that, so when things get rocky, you can rely and remind yourself, this is my investment strategy. This is why it's going to be good in the long run, right? So that you can talk yourself through those negative downturns. That is really the best way to do it, but to be in the market nonetheless, right? Even though you know it's going to go down. So that's lesson number 1. Now, lesson number 2 is you need to be diversified, right? And how to diversify kind of depends on what your investment strategy is. But as a beginner, I would say that there's kind of like two tiers I would break it down into. One is if you are investing with the goal in mind of retirement and you are not intending to take that money out at any point before your retirement, and you're fairly young, then what you would want to do is most likely invest into what is called a target date fund. Vanguard has target date funds, Fidelity has target date funds. There are other investment advisor companies that have target date funds. They will usually be very simple to understand because in the title of the target date fund will include a year that is the year that you should be targeting as your retirement year, right? So if you are 30 years old now and you plan to retire at the age of 65, right? Then you would add 35 years onto whatever this year is. It would retire in, what is that, 2000? So you would retire in 2056. So you would pick a target date retirement fund with the number 2056 in its title. So that is like a very, very simple way to invest toward retirement without having to put too much calculus into it. These funds are already diversified. These companies like Vanguard and Fidelity they have investment advisors who are helping to allocate the fund's holdings. And throughout the course of the years that this fund is going on, as it gets closer to that retirement date or the target date, they will reallocate the funds. So perhaps they hold 70% stocks in the beginning and a lower percentage of bonds. And then as they get closer to the end, they get rid of their higher risk stocks and they go to lower risk bonds or something else that might not have as big of a reward, but is lower risk because now you're getting closer to retirement age. And so you're less willing to risk all of the money in that account, right? So, and you have a smaller time horizon to recover any downturns in that fund. So they already manage all of that for you and you don't have to worry about it. It's kind of a little bit of like a set it and forget it. But usually the way these work is that you should be aiming to like not really take the money out earlier than that target date. So if you're looking to invest in a shorter time horizon, right? You're not saying like, oh, I'm going to take it out 30 years from now. You want to be able to take it out 5 years from now or 10 years from now or what have you. Or you want to at least have the option to take it out within the next few years. Then what you can do is research. Now this obviously requires a little bit extra work than the other strategy where you're just kind of setting it and forgetting it and picking a target date fund. In this way, you have to do a little bit more work, a little bit more research. The reward might be a little bit greater, but you definitely have to manage it yourself and understand your investment strategy over time. But then you can kind of pick ETFs or index funds or mutual funds, and you can essentially say like which industries or types of companies you want to invest in. There are all different types of ETFs and mutual funds. You can basically say what percentage you want to allocate to different types of funds. You can look to guidance from people like Warren Buffett. There's other guidance from other experts in the field as far as how to allocate your portfolio percentage-wise of your investments into various industries and size companies and things of that nature, depending on your age and the number of years you're investing in all of these different things. So like you would have to do a little bit of research into that. And then you can pick from anywhere to having, let's say, like investing in an ETF that is specific to the S&P 500, right? And so that's going to follow all of bigger sized companies that are like the top companies in America, for example, top performing companies. And then you might put a percentage of your portfolio into an index that mimics the S&P 500. Or you might say like, oh, I want to diversify and include some foreign stocks as well in case the markets in America turn down. And so you can say, I want to put whatever it is, 15%, 20%, whatever you decide, toward an index fund or an ETF that tracks foreign stocks. And then there's differences between what size those companies are, whether you're following mid-cap or small-cap companies, meaning smaller companies that are maybe have more potential room for growth versus larger companies that are kind of the dominating in their industry and in the country. And so you don't really want to hold 100% in one industry or 100% in one company type, right? As far as like size, because there are pros and cons to each of them. And so to diversify and to hold a percentage of each is the best way to shield yourself from any potential exposure or risk with respect to any given industry, which like you couldn't really predict if one industry is going to take a downturn or another. So for example, a lot of people will always be like, oh, just invest in the S&P 500. But then because in the last year, the Fed has lowered interest rates, that has pushed everyone to take their money out of savings account and money markets accounts and to push that money into the stock market. And most people who don't know what else to invest in will automatically invest in the S&P 500. Then it could end up that the S&P 500 gets overvalued, right? Because there's more money going into it than what is its value because people don't know where else to put their money. So it might burst and then the S&P 500 ends up taking a dive. And some of these other mid-cap stocks, small-cap stocks, foreign stocks, emerging market stocks, right? Some of these other funds that focus on these other things might end up doing better at those points in time. So there are different points in time where different types of industries or types of companies have performed better than others. And so it's good to be diversified and to hold something in each, but you can do it through a fund rather than having to pick individual stocks or companies, because that is even then so much more research and work that you need to do in order to track, to first understand like all of the numbers into why you want to invest in a specific company, to track that company, to track news related to that company, politics related to that company, any regulation related to that company, right? When you invest through a fund or through an ETF or through a mutual fund or an index fund, you're going to be relying on those fund managers to manage all of the research and the work and the politics and the regulatory issues as far as keeping up to date on that information, to determine whether or not they want to transfer a certain holding, sell more of a certain holding, buy more of a certain holding. And you're kind of relying on them to do that, but you are picking what space you want that fund to be in. So you might say 20% S&P 500, 15% emerging markets, 15% mid-cap, small cap, like whatever it is, right? Whatever percentage-wise you pick. But you're gonna then try to find a fund that meets that category. There can be benefits to that. It's obviously more work, strategically speaking. There are obviously other investment strategies than the two that I just mentioned, but for beginners, I think that those are really two good places to start. If you keep a 401k, it's kind of along the lines of the initial investment strategy I mentioned, which is the target date investment funds. Your 401k is most likely a target date investment fund. So if you already have that, you might decide to venture out and to try this other strategy where you are investing into specific funds that you have selected based on industries and company sizes and all of that they track. The most important things I would say when it comes to understanding your investment strategy and committing to an investment strategy are the next two things that I'm going to say. So you really want to pay close attention to these next two things, which are the most important things. First of all, when stocks fall, which they will, okay? They will. You do not want to panic sell. You are going to feel the need to panic sell. You are going to have to physically fight with yourself not to, because it goes against all of your human nature. Your human nature is that you are going to want to sell. And it will be really hard for you not to see those numbers diving down and all of that red and thinking about how hard you worked for that money and not to sell. But the problem is, if you sell, chances are you're going to be selling too late, and chances are you're going to be selling at a low. And then you're really going to be kicking yourself when that shoots right back up as soon as the market starts to recover. And you will have missed out on the 10 best days, because the 6 out of those 10 tend to follow the 10 worst days, right? So that is why you cannot panic sell when the market turns down. That is why you're not going to invest with money that you need to be able to use within the next couple of years, couple of months or something like that in order to live day to day, right? You're not going to be investing with rent money. You're not going to be investing with money you need for groceries. You're not going to be investing with money you need to retire. This is why it's very important, because you need to remove the emotion to make it a little bit easier on yourself when it will be really hard for you to make the decision not to sell when the market turns down. And that is something that, listen, I wish I had told myself. There are times when I sold and I kicked myself afterwards, and it ended up I bought high and I sold low, and then I really wish that I hadn't. That's happened to me more than once. I've learned from experience. It's not a good idea. From the historical perspective of the stock market, always ultimately recovering, always ultimately ending up higher than what it was prior, right? So just based on that alone, that is why I'm giving you this advice. Now, is it possible for there to be the first time ever in all of history for that not to be the case? It's possible, okay? Anything is possible. It isn't a 0% likelihood, but it's, from my perspective, my personal, humble, unprofessional perspective, very unlikely to occur, okay? And you're gonna need to have faith in whatever your investment strategy is. The final point that I want to make, and this is the most important of it all, because this also helps you to take comfort in the fact that the market will eventually go down. It is a concept called dollar cost averaging. Dollar cost averaging is how you can invest if you do not know how to time the market, which nobody does, right? Nobody knows how to time the market. It's all speculation. So because of that, dollar cost averaging is a theory that says that if you can't time the market perfectly, you're going to take whatever amount of money you have that you've allocated for investing. Let's say that's $12,000. And instead of making a $12,000 investment in one go today, in whatever investment portfolio breakdown that you've decided on, you say, I'm going to instead break that $12,000 over a long-term time horizon. Let's say that's a year. And instead I will invest $1,000 a month for 12 months, which will add up to that $12,000. And I will do it at the same time every month, regardless of whatever the buy-in price is for the fund allocation that I've selected, regardless for whatever the buy-in price is that month. With the theory that some months you might end up paying a little bit high, but other months you're probably going to get it at a pretty low price, and those will all average out. And the longer the time horizon is, the better that this strategy is meant to work, right? Because the idea is that you are going to have some highs and some lows, and it will all average out, and ultimately the average price you paid per share will be a reasonable good price. And so your earnings should reflect that, and should reflect that you bought in at a very reasonable, good price on average. And so that is an investment strategy to have, but you need to be committed to it, right? You can't then decide, oh, well, I'm not going to buy this month because it feels really high, because for all you know, it could just go up higher and you could have missed the boat, right? Because you really don't know how to time it. And that's the entire point of this investment strategy. So you just have to be committed to it if that's what you pick, understanding that you're taking on the risk that it could go down and that you could end up having paid a lot of money for a certain month, right? For a certain number of shares in any given month. But when that happens and the price potentially goes down and you feel like you're kicking yourself that you paid extra last month for these shares that are worth a fraction of that price now, rather than selling, which you might be inclined to do because you feel it's all tanking, rather than selling, that is the best time to buy more, right? Which is why you're going to keep doing this repeatedly, like $1,000 a month, let's say in the scenario we discussed, and the next month you're going to get it at that bargain price, and the month after that maybe you're going to get it again at a bargain price if it hasn't recovered yet, right? And those things will all average out. And going back to just the point I made right before this, which ties right into this point, when you feel the inclination to sell because things are going bad and the market is turning downward and everyone around you is panicking and everyone around you is wanting to sell, that is an indication that it's probably a good time to buy. And it sounds very counterintuitive, and it will feel like it is against everything within your body to buy at that time. But that is what all of the major investors who have made a killing in investing do. That is the time when they buy. They buy when everyone else is selling, right? I'm sure you've heard this. Buy low, sell high, right? Easier said than done. I've made the mistake of not following that advice myself personally. It is advice that I try to remind myself of every time the market falls. And it is a constant exercise that you have to have with yourself where you can say, I am going to decide what my investment strategy is. And it might not be something that I've meant during this video, right? It very well might not be. But whatever your investment strategy is, you need to be committed to it, okay? And the name of the game is holding for the long term, not for the short term. So don't panic in the short run, all right? So that's my best advice for investing for beginners. These thoughts should just be one input or one piece of your ultimate decision on how to invest, how to develop your investment strategy. You should do other research outside of just listening to this video. Don't just act on this video. It is just, one person's thoughts on the matter. If you enjoy this video, please give it a thumbs up. Please subscribe. It really would mean a lot to me, help out my channel a lot. And if you enjoy the content, please leave a comment down below to let me know, and I will put out more videos just like this one.